Have you ever looked at your bank statement at the end of the month and wondered why you were charged $12 just for keeping your own money in an account? Or maybe you tried to deposit a check, only to find out the bank was holding your funds for 3 to 5 business days right when you needed to pay rent. Managing your money shouldn't feel like a constant battle against hidden fees, slow processing times, and arbitrary account minimums. Yet for decades, millions of people have accepted these inconveniences as the price of doing business with traditional brick-and-mortar financial institutions. Enter fintech companies like Chime. You have likely seen the ads promising no monthly fees, early direct deposit, and fee-free overdraft protection. It sounds like an ideal solution, especially if you are tired of losing hard-earned cash to maintenance charges. But switching where your paychecks land triggers real anxiety. Is a tech platform actually safe? What happens if your card gets compromised or your account gets frozen with no physical branch to walk into? What if you need to deposit cash or speak face-to-face with a bank manager to resolve a complex dispute? The fear of losing control over your liquid assets or being left stranded without customer support keeps many people locked into traditional banking systems, even when those systems feel outdated and expensive. To understand the core difference, we first have to clarify what Chime actually is. Chime is not a bank. It is a financial technology company that partners with FDIC-insured partner banks, such as the Bancorp Bank or Stride Bank, to handle your deposits and issue your cards. Traditional banks like Chase, Bank of America, or Wells Fargo are direct financial institutions holding their own banking charters, maintaining physical branch networks, and offering a full suite of financial products ranging from checking and savings to mortgages, auto loans, and wealth management. The main problem with traditional banks comes down to overhead. Maintaining thousands of physical locations, paying branch staff, and operating legacy technology costs billions of dollars. Traditional banks offset these operational costs through consumer fees, monthly maintenance fees if you do not meet strict daily balance minimums, overdraft charges that can cost up to $35 per transaction, and out-of-network ATM fees. For someone living paycheck to paycheck or just starting their financial journey, these fees act as a tax on low balances. Chime strips away those physical overhead costs entirely. Because it operates digitally, it generates revenue primarily through interchange fees, the small percentage charged to merchants every time you swipe your Chime Visa debit card. This business model allows Chime to offer accounts with no monthly maintenance fees, no minimum balance requirements, no foreign transaction fees, and access to an extensive fee-free ATM network via systems like Allpoint and MoneyPass. However, the convenience of digital-only platforms comes with trade-offs that address valid consumer fears. One major worry with neobanks is security and regulation. With a traditional bank, your money is directly insured up to $250,000 per depositor through the FDIC, backed by the full faith of the federal government. With Chime, your funds are still FDIC insured, but that coverage flows through its partner banks. As long as your money is deposited properly with the partner bank, it carries the exact same federal protection. The risk arises in operational customer support. If a digital account is flagged for suspicious activity, account freezes are handled through app-based tickets or phone support rather than an in-person conversation with a local branch manager. For people who handle frequent cash deposits, traditional banks still hold a major structural advantage. Depositing cash at a traditional bank ATM or teller is instant and free. On Chime, cash deposits generally require visiting retail locations like Walgreens or CVS, which may incur third-party processing fees. So, how do you decide which setup fits your personal financial life? The actionable takeaway comes down to evaluating your daily money habits and long-term financial goals. If your income relies heavily on cash transactions, if you prefer face-to-face service for complex resolving issues, or if you plan to apply for multi-product services like mortgages, personal loans, or joint accounts under one roof, a traditional bank or a local credit union remains the stronger foundational choice. You can minimize traditional banking fees by maintaining required minimum balances or setting up qualifying direct deposits. If your primary focus is eliminating monthly maintenance and overdraft fees, receiving your direct deposit up to 2 days early, and managing your money entirely from a mobile interface, Chime offers a streamlined, cost-effective alternative. For many consumers, the smart strategy is a hybrid approach. You do not have to pick strictly one or the other. You can maintain a basic checking account at a traditional bank or local credit union for cash handling, physical branch access, and establishing a relationship for future loan products, while using a platform like Chime for your primary day-to-day spending and budgeting. By understanding how each system makes its money and protects your assets, you can structure your accounts to eliminate unnecessary fees while keeping your money secure and accessible.